If you have money sitting in a traditional IRA or an old 401k, the rules on when you must start pulling it out changed again for 2026. And if you get your exact starting age wrong, you could end up handing thousands of dollars to the IRS in penalties without even realizing it until it is too late. Here is what almost nobody explains correctly. There is a birthday trap hiding inside this rule that can force you into taking 2 full withdrawals in the same calendar year and quietly pushing you into a higher tax bracket without you ever missing a single deadline. And there is a second thing buried in this update that is actually good news for once. The penalty for getting this wrong used to be brutal. It just got cut dramatically. Stay with me, because by the end, you will know exactly which age applies to you, the trap to avoid, and the one move that turns your required withdrawal into a tax-free gift instead of a tax bill. My name is Kevin. If you are new here, this channel exists for one reason. We read the rules that decide what happens to your money, so you find out before the system decides for you. Subscribe and turn on the bell, because this rule touches almost every retiree in America who saved the traditional way. Let me start with the basics, because even if you think you already understand this, there is something coming you likely have not heard. A required minimum distribution is the amount of money the federal government forces you to withdraw every single year from accounts like a traditional IRA, a 401k, or a 403b once you reach a certain age. Verified card. Source: Internal Revenue Service, IRS.gov. Here is why this rule exists. When you were working, you put money into these accounts before taxes were taken out. That lowered your taxable income back then. But the government was not giving you a free pass forever. They were only letting you delay the tax until later in life. Eventually, they want their share. The required minimum distribution is how they make sure that happens on a schedule they control. Now here is the part that actually changed. For 2026, your starting age depends entirely on the year you were born. Verified card. Source: Internal Revenue Service, IRS.gov, Secure Act 2.0. If you were born before July of 1949, your required age was already 70 and a half under the old rules. If you were born between July of 1949 and the end of 1950, your starting age became 72. And if you were born between 1951 and 1959, 73 is your number for 2026. If you are younger than that, born in 1960 or later, the age moves further out to 75 under the law as it currently stands. Here is why the age keeps moving instead of staying fixed at one number. Verified card. Source: Internal Revenue Service, IRS.gov, Secure Act 2.0. Congress passed a law called the Secure Act back in 2019 and then expanded it with a second version a few years later. People are living longer than they were when the original age of 70 and a half was first written into law decades ago. Lawmakers gradually pushed the starting age higher in stages rather than all at once, which is exactly why your specific age depends so heavily on the exact year you happen to be born. It is not a single cutoff for everyone. It is a staircase, and where you land on it is determined entirely by your birth year. So the very first thing I want you to do right now is figure out exactly which bracket you fall into, because getting this wrong is the single most common and most expensive mistake retirees make. Let me tell you about Emmett. Emmett turns 73 sometime in 2026. He lives outside Peoria, Illinois. 32 years as a machine tool operator. Under the new rule, 2026 is officially his first year required to take a distribution from his traditional IRA. Now here is something a lot of people do not realize. Emmett has a special one-time grace period. He is allowed to delay that very first required withdrawal all the way until April 1st of the following year, 2027, instead of taking it by December 31st of 2026, like every year after that. Verified card. Source: Internal Revenue Service, IRS.gov. That sounds like a nice little break. Here's the catch. If Emmett waits and takes his first withdrawal during that grace period in early 2027, he still has to take his second withdrawal, the normal one, for that same year by December 31st of 2027 as well, which means Emmett could end up taking 2 full required withdrawals in the exact same calendar year. That stacks up as taxable income. It can push him into a higher tax bracket than he expected, and it can raise his Medicare premiums the following year because of something called IRMAA, which I will explain shortly. Emmett almost fell into this exact trap. He assumed delaying was automatically the smarter move. His accountant ran the numbers, both ways, and found that taking his first withdrawal on time in 2026, instead of stacking 2 into 2027, kept his income smoother and his tax bracket lower for both years combined. It is not one size fits all, but you have to actually run the numbers instead of assuming the delay is a gift. If this is the first time anyone has explained that the grace period can actually work against you, do me one favor. Subscribe and turn on the bell, because next week I am covering the exact ages where Medicare premiums jump the hardest because of this rule. Now let us talk about the number that scares people the most, the penalty. Here is genuinely good news buried inside all of this. The penalty for missing your required withdrawal or not taking out enough used to be brutal. In the past, if you failed to take your full required distribution, the IRS could hit you with a 50% excise tax on the amount you should have withdrawn but did not. Verified card. Source: Internal Revenue Service, IRS.gov. 50%. If you were supposed to take out $10,000 and missed it completely, you could have owed $5,000 in penalties alone, on top of the regular income tax once you finally took it out. Under the current rules, that penalty has been reduced. If you miss a required withdrawal now, the penalty is 25% of the amount you failed to withdraw. Verified card. Source: Internal Revenue Service, IRS.gov, Secure Act 2.0. And here is the part that really matters. If you catch the mistake and correct it within a certain window, generally by fixing it and filing the correct paperwork in a timely manner, that penalty can drop even further down to 10%. That is a massive difference from where it used to be. But do not let this make you complacent. 10% or 25% of a large retirement account withdrawal is still real money. Let me tell you about Alma. Alma is 76. She lives in Butte, Montana, widowed 3 years ago. She had been taking her required withdrawals faithfully every year for 3 years. Then her husband passed, and in the fog of that first year alone, she simply forgot. December 31st came and went, no withdrawal. She caught the mistake herself in February, going through old statements for her taxes. Her required amount that year was $14,000. Because she caught it and corrected it quickly, her penalty was reduced to the lower 10% rate instead of $2,500, $1,400 instead of $3,500. Still real money, still a mistake that cost her something. But under the old 50% rule, that same mistake would have cost her $7,000. The system got less brutal. It did not get forgiving. The lesson is simple. The penalty got smaller. It did not disappear. And the smartest move is still to never miss the deadline in the first place. I want to stop here for a moment because Alma is the exact reason I built the thing I am about to tell you about. Nobody sent her a reminder. Nobody told her the deadline does not care that she was grieving. The rules that governed her own money were written in a language designed to assume you already know them. That is why I put together a plain English guide called The Quiet Rules. It is the drawer version of everything I cover on this channel. Written large, written simple, the exact age brackets, the exact deadlines, a simple way to calculate what you owe before the year runs out. Because the families who never pay a penalty are the ones who know the date before December arrives. You can find it at kevinexplains.shop. The link is right below this video, or scan the QR code on your screen right now. It is also in the pinned comment. 7-day guarantee, always. If it does not give you something you did not have before, you send it back. Before we move on, let me show you exactly how this amount even gets calculated, because a lot of people assume it is some mysterious formula only an accountant can figure out. It is actually fairly straightforward. Verified card. Source: Internal Revenue Service, IRS.gov. Your required amount for the year is calculated by taking your account balance as of December 31st of the previous year and dividing it by a life expectancy factor published by the IRS in what is called the Uniform Lifetime Table. So, for example, if your account balance at the end of last year was $500,000 and the IRS factor for your age is roughly 26.5, you would divide 500,000 by 26.5, and that gives you your required withdrawal for the year just under $19,000. That amount changes every single year because both your balance and your life expectancy factor shift as you get older. You cannot set an amount once and forget about it. You or your financial advisor need to recalculate this every year based on your updated balance. Now let us talk about a change that genuinely helps a lot of retirees. And this one is about Roth accounts. If you have a Roth 401k or a Roth 403b through your employer, here is something that used to trip people up constantly. Roth IRAs were never subject to required withdrawals during your lifetime. But a Roth account sitting inside an employer plan, a Roth 401k, actually was. Verified card. Source: Internal Revenue Service, IRS.gov. Secure Act 2.0. Two accounts, both holding money that was already taxed, already growing tax-free, treated completely differently, depending only on which type of account it happened to sit in. That inconsistency has now been fixed. Roth 401k and Roth 403b accounts are no longer subject to required withdrawals during the original account holder's lifetime, which brings them in line with how Roth IRAs have always worked. This is a real win for retirees who have been diligently contributing to a Roth option at work. That money can now keep growing, completely tax-free for as long as you want, without the government forcing you to pull it out on a schedule. Let me tell you about Garnet. Garnet is 74. She lives outside Chattanooga, Tennessee. For 18 years, she contributed to a Roth 401k at the hospital where she worked as a surgical technician. Every year, her old required withdrawal notice confused her. Why was she being forced to pull money out of an account she had already paid the tax on? It never made sense to her. It did not have to make sense. It was simply an inconsistency in the law that nobody had ever fixed. Under the new rule, that account no longer generates a required withdrawal at all. Garnet can leave it exactly where it is, growing completely tax-free for the rest of her life, and pass it to her children the same way. But listen closely here, because there is an important exception people miss constantly. This more relaxed treatment only applies to the original account holder while they are alive. If you inherit a Roth account, whether it is a Roth IRA or a Roth 401k, from a parent, a spouse, or anyone else, the required withdrawal rules for beneficiaries still apply to you. Verified card. Source: Internal Revenue Service, IRS.gov. Beneficiaries are not off the hook just because the money originally came from a Roth. If you recently inherited a retirement account, do not assume you are automatically exempt. The rules for inherited accounts are their own separate maze, and getting that wrong is another very common and very costly mistake. Now let us talk about something that connects directly to your required withdrawal, but almost nobody explains properly: qualified charitable distributions. If you already give to charity, your church, a local food bank, an animal shelter, this next part could genuinely put more money back in your pocket every single year. A qualified charitable distribution lets you send money directly from your IRA straight to a qualifying charity. That amount counts towards satisfying your required withdrawal for the year. Verified card. Source: Internal Revenue Service, IRS.gov. But here's the powerful part. It does not count as taxable income to you. Normally, when you take a required withdrawal, the entire amount gets added to your taxable income for the year. That can push you into a higher bracket. It can increase how much of your Social Security gets taxed. It can even raise your Medicare premiums through the IRMAA surcharges I mentioned earlier. But when you send that money directly to charity through this kind of distribution, instead of taking it as cash first, it skips your taxable income entirely. The limit on how much you can give this way each year has been indexed to inflation and now sits well over $100,000 per person. Verified card. Source: Internal Revenue Service, IRS.gov. Confirm current year indexed figure before filing. That is a significant amount of room for retirees who are charitably inclined to lower their tax bill while still meeting their required withdrawal and supporting causes they actually care about. Let me tell you about Ruben. Ruben is 78. He lives in Tulsa, Oklahoma. His required withdrawal this year comes out to $15,000. If Ruben takes that as a normal cash withdrawal, all $15,000 gets added to his taxable income. That could bump him into a higher bracket. It could increase the taxable portion of his Social Security too. But if Ruben instead directs that same $15,000 straight from his IRA to the church he has attended for 40 years, using this exact provision, the $15,000 still satisfies his required withdrawal completely. It never shows up as taxable income on his return. Same withdrawal amount, same requirement satisfied, completely different tax outcome. This is one of the most underused strategies in all of retirement planning. Now let us talk about how this connects to IRMAA, because this is where people get blindsided. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a surcharge added on top of your regular Medicare Part B and Part D premiums if your income crosses certain thresholds. Verified card. Source: Medicare.gov. Here is the part that catches people off guard. Medicare looks at your tax return from 2 years earlier to determine whether you owe this. So if your required withdrawal pushes your income higher this year, you might not feel it immediately. But 2 years from now, your Medicare premiums could jump, sometimes by hundreds of dollars, a month, and it can feel like it came completely out of nowhere. This is exactly why strategies like the charitable distribution we just covered, or careful timing of when you start, matter so much. It is not only about avoiding a penalty, it is about protecting your entire financial picture, including what you pay for healthcare down the road. Let me tell you about Dovey. Dovey is 75. She lives outside Fort Wayne, Indiana. 2 years ago, her first required withdrawal pushed her income up by about $30,000 for that 1 year. She did not notice anything change at the time. Her Medicare premium stayed exactly the same that year. Then, this January, her Part B premium jumped, not by a small amount, by well over $100 a month more than before. She called Medicare confused. Nothing about her income this year had changed. They explained the surcharge was based on her tax return from 2 years earlier, the exact year her first required withdrawal landed. Dubby had no idea a single large withdrawal could reach forward 2 full years and quietly raise what she pays for healthcare in a year that otherwise looked completely normal. That surcharge will follow her for the full year before it can adjust again. If she had spread part of that withdrawal through a charitable distribution, the way Ruben did, her taxable income that year would have stayed lower, and the surcharge may never have triggered at all. Now let me show you a mistake that has nothing to do with the calculation itself and everything to do with timing. The deadline for taking your required withdrawal outside of that special first-year grace period is December 31st of each year. Not January, not the following spring when you file your taxes, December 31st. Set up automatic withdrawals with your brokerage well before the holiday season hits, because the last 2 weeks of December get busy. Financial institutions can have processing delays. The last thing you want is to miss a hard government deadline because your paperwork got stuck in the holiday rush. Now let me show you one more change that connects to this same age range, even though it affects people still working. If you are still employed somewhere in your 60s, consulting or working part-time, while also managing required withdrawals from old accounts, listen closely. Under recent changes, if you are 50 or older and your wages from the prior year crossed a certain threshold, any catch-up contributions you make to an employer plan now have to go into a Roth account rather than a traditional pre-tax account. Verified card. Source: Internal Revenue Service, IRS.gov, Secure Act 2.0. This mostly affects people who are still working later in life and earning a higher income. But I bring it up for a reason. It shows you something important. These rules are not static. They shift, they get adjusted, and the government keeps fine-tuning how pre-tax money versus Roth money flows through the system. If you are someone still working part-time while also managing required withdrawals from old accounts, these overlapping rules can get complicated fast. This is exactly the kind of situation where sitting down with a qualified tax professional for even 1 hour can save you far more than that hour costs. Now let me show you a mistake I see constantly, and it might be the most expensive one on this entire list. If you have multiple traditional IRAs spread across different banks or brokerages, you are allowed to calculate the required amount for each account separately, and then combine the total and withdraw it from just one or a few of those accounts. As long as the total withdrawn meets or exceeds what all of your IRAs combined require. Verified card. Source: Internal Revenue Service, IRS.gov. But this flexibility does not apply the same way to workplace retirement accounts like 401k plans. If you have multiple 401k accounts from different employers, you generally have to calculate and withdraw the required amount separately from each individual account. People mix this up constantly, assuming they can lump everything together the way they can with IRAs. That mistake alone can trigger a missed withdrawal penalty on an account they thought they had already covered. If you have several old 401k accounts sitting around from previous jobs, this is exactly the kind of detail that trips people up. And it is one of the strongest reasons some retirees choose to roll old 401k accounts into a single IRA before they hit this age, just to simplify the entire process. Now let me show you one more detail that only applies to a specific group, but matters enormously when it does. If your spouse is more than 10 years younger than you and is the sole beneficiary listed on your account, a different, more generous table is used to calculate your required withdrawal. Verified card. Source: Internal Revenue Service, IRS.gov. That table results in a smaller required withdrawal each year than the standard table everyone else uses. The logic makes sense once you see it. The government assumes the account needs to last across both of your lifetimes, and a younger spouse is statistically likely to live considerably longer. If this applies to you, and your account custodian is not using that table, you may be withdrawing more than you actually have to every single year, and paying tax on money that could have stayed invested longer. It is worth one phone call to your custodian simply to ask which table they are using for your account. I think about Alma again and about Emmett, and I want you to notice something. Neither one of their mistakes came from carelessness. Alma was grieving. Emmett was trying to do the smart thing by taking the grace period. The rules do not ask whether you had a good reason. That is exactly what the quiet rules is built to prevent. It holds the age brackets, the deadlines, the aggregation rules for IRAs versus 401ks, the exact way to calculate a qualified charitable distribution so it actually counts instead of accidentally landing as regular taxable income. Because the difference between a family that plans ahead and a family that pays a penalty is almost never intelligence. It is simply knowing the calendar before it runs out. You can find it at kevinexplains.shop. The link is in the description and in the pinned comment at the top. Or scan the QR code on your screen right now. 7-day guarantee, no questions asked. Now, your action checklist. 6 things. This week. Step 1. Figure out your exact starting age based on your birth year using the brackets we covered in this video. Write it down. Step 2. If you are approaching that age this year or next year, calculate roughly what your first required withdrawal will be using your account balance and your age. Most brokerages will calculate this for you automatically. Ask them to show you. Step 3. If you are turning your required age this year, decide in advance whether taking your first withdrawal on time makes more sense than delaying into the grace period. Do not assume the delay is automatically the smarter move. Run the numbers, or ask someone to run them for you. Step 4. If you are charitably inclined, seriously consider whether directing part or all of your required withdrawal through a qualified charitable distribution could lower your taxable income while supporting a cause you actually care about. Step 5. If you have multiple retirement accounts, especially old 401k accounts from previous employers, find out whether you are required to withdraw from each one separately or whether consolidating them into a single IRA might simplify your life and reduce your risk of an accidental missed withdrawal. Step 6. Share this video with a parent, a sibling, or a friend who is approaching this age and might not know any of this changed. It could save them thousands of dollars. And if you want me to look at your specific situation, email me at kevinexplainsofficial@gmail.com. I read every one. Let me leave you with the single most important thing from everything we covered today. Think back to everyone in this video. Emmett, who almost took 2 withdrawals in a single year without realizing the grace period could work against him. Alma, who forgot 1 deadline while grieving and paid for it even at the lower rate. Garnet, whose Roth account no longer forces her to withdraw a dime she does not need. Reuben, who turned his required withdrawal into a gift that never touched his tax return. And Dovey, whose Medicare premium jumped 2 full years after a withdrawal she had already forgotten about. Every one of them was managing the exact same rule. The difference in every single story was never intelligence, and it was never effort. It was whether someone knew the calendar before it ran out. Your required age for 2026 depends entirely on when you were born. Getting that number wrong is the root cause of almost every other mistake we talked about today. Once you know your correct starting age, everything else, the calculation, the deadlines, the charitable strategies, the way it connects to your Medicare premiums, becomes so much easier to plan around. Do not let confusion around one number cost you money you worked your entire life to save. I am Kevin. Thanks for watching. Do not forget to check the quiet rules at kevinexplains.shop.